Good day, I'm Thomas Friedberger, Deputy CEO of Tikehau Capital. The change in economic model based until now on the quest for infinite growth in an environment of low or even negative interest rates, where efficiency and optimization prevailed, to a more local model where resilience is becoming essential, is paving the way for radical change in our economies and the way we invest. This world, where resilience takes precedence over efficiency, can only be built thanks to an increased weight of states in the economy and a cycle of massive investment spending. So let's talk a little bit about the weight of states in the economies that are rising sharply. The need to create resilience in a context of deglobalization and geopolitical tensions marks the returns of industrial policies and strategic sovereignty plans. It is therefore not surprising to see the use of aggressive fiscal policies to direct savings and investments toward building resilience. In all major economic powers, the weight of governments in the economy is increasing. The weight of public investments is expected to continue to grow through industrial policies and strategic initiatives in the various economies, particularly in the United States, Europe, China, Japan, and India. This trend could lead to a less optimal capital allocation and a possible decline in financial returns. So let's talk a little bit about CapEx needs to build resilience. This explosion in investment needs, fueled by the 4Ds, deglobalization, decarbonation, defense, and digitalization, represents both an investment opportunity and a risk for investors. The 4Ds will trigger the largest capital expenditure cycle in history. In 2022, the consulting firm McKinsey estimated the amount of capital expenditure needed by 2027 at $130,000 billion, more than one time the world's GDP. Is this good news? Well, provided that capital expenditure create economic value, a massive need for capex in one segment of the economy is a positive sign, as such expenditure theoretically create new jobs, improve the productivity of existing ones. However, experience shows that this is rarely the case. So why? Because only the most competent management teams manage to efficiently allocate the company's free cash flow to productive investments. This calls for remaining positive about growth, but very selective, rigorously analyzing the quality of management teams and paying great attention to long-term returns on capital measures. We can therefore expect an increase in the dispersion between the performance of companies, but also between the performance of states through the cost of financing their debt. So that's a measure of it. Now let's say a word about the changing dynamics for China and the United States. Indeed, it's impossible in 2025-2026 to have investment convictions without trying to understand the changes in the dynamics of the world's two largest powers. For the investor, it seems to us that the two major important questions for defining an asset allocation over the long terms are: number one, is American exceptionalism, which justifies the gap in US valuations vis-à-vis the rest of the world and the dollar status as the only reserve currency, sustainable? And number two, are there credible alternatives to the dollar as a currency of exchange and the United States as an investment destination in an asset allocation? So, is American exceptionalism sustainable? This question is important as the US market benefits from a significant valuation premium. American dominance is based on three pillars. One, economic, with deep and liquid capital markets, universities attracting the best talents, a dynamic job market, a business-friendly rule of law, and an attractive tax system for companies. Number two, military. And number three, monetary, and the imposition of the US dollar as the only reserve and exchange currency. This status translates into an increased weight in global asset allocation. As a result, the S&P 500 is trading at more than 25 times 2026 earnings, actually 28 times, a considerable premium to the valuation of the MSCI World ex-USA. Two financial elements are added to the list of arguments in favor of US overallocation. A less recession-prone economy, the underlying structure of the economy is more robust. Then a significant difference in performance between American companies and others. The return on equity of the S&P 500 is 9 points higher than the rest of the world's 21% versus 12%. That helps explaining the valuation premium of the US stock market compared to the MSCI World ex-US index. So, is this price-earning ratio of more than 25 times sustainable? For it to be so, three elements seem necessary. First, the conviction that the United States will continue to give itself the means of its economic, military, and monetary domination. Then, the belief that American technological supremacy truly remains unmatched. Hence, the importance of monitoring the development of DeepSeek and other non-American models. Third, maintaining higher operating margins for US companies. In this context, the impact of tariffs and the long-term status of the US dollar could play a role. In any case, the United States seem to have opened the Pandora box on two issues. First one is the debt. With $30,000 billion in outstanding US Treasury bonds, the big question remains, who will finance that? Of course, deregulation will allow American banks to buy more domestic debt, but in the long term, the United States will not be able to do without foreign financing. Then the rule of law. The militarization of the US dollar and the threat of foreign asset freezes for countries not aligned with the US policy call into question one of the explanations for the US exceptionalism. By encouraging the financiers of the American exceptionalism to reallocate their investments either locally or to alternative geographical or even monetary areas, the long-term risk for the United States is twofold. Number one, causing a crisis in the financing of the American debt. And number two, accelerate the loss of the US dollar status as the only reserve currency. So, does this risk offer an opportunity for China or a group of countries structured around China? What will be the consequences for the status of the US dollar? Are there credible alternatives to the dollar as a currency? The Chinese economy is undergoing a new structural change under the triple effect of demographic change, deglobalization that impacts its export-based model, and the strategic choices made by the Chinese government. After focusing on the development of the real estate market to regulate urbanization until the COVID crisis, China's priority has become the financing of its industry with the aim of reducing dependence on the West. In the current geopolitical context that threatens China's export model, it seems that the priority is becoming the development of consumption in China. This explains the recent monetary and fiscal stimulus efforts. The development of the domestic market seems to be the only solution to maintain GDP growth and avoid massive unemployment and social unrest. At the same time, China seems to be quietly working to develop a zone of monetary influence in Asia. Thus, the volatility of Asian currencies against the renminbi is steadily decreasing. For its part, the Asian Development Bank is multiplying financing in its currency to Asian countries. In this context, it is interesting to observe the evolution of relations between the three great Asian powers, China, Russia, India. Russia is rich in raw materials. China has manufacturing capacity, and India has demographic dynamism with 20% of young people under 20 years old. A hypothetical rapprochement between Russia, India, and China could eventually upset the global economic balance. The growing tensions between the United States on the one hand and the BRICS on the other, particularly on the subject of the use of the US dollar in trade, is the proof that something is changing. Now let's talk about Europe. Europe, according to us, represents a unique investment opportunity. Never had the theme of European sovereignty been so topical. 2 years ago, we published a letter on this topic with the conviction that the construction of a form of sovereignty on the whole continent would create economic value. It is clear that this trend is accelerating significantly. European integration has often progressed in phases of crisis. This episode is no exception to the rule. Contrary to those highlighting the weakness of the old continent, we continue to see Europe as a significant investment opportunity. Germany's fiscal stimulus choices and the end of the consolidation of Southern European banking system are simultaneously removing the two main forces that were holding back growth in Europe. So what is the basis for this European conviction? Well, first, the orientations taken by Germany are a game changer in terms of fiscal stimulus, the release of funding at the level of the European authorities, and the anchoring of Germany within a genuine strategy of European sovereignty. Number two, the European banking system is completing its restructuring. Financial institutions in Southern Europe are now much stronger than in the past decades, as evidenced by the market capitalization of Spanish and Italian banking groups. The European banking system is sound, and appetite for risk is back. Number three, the speed at which public and private sector players have mobilized to redefine industrial priorities the means to finance them, and collaborate together to catch up with the United States in terms of technology and finance, encourage us to invest significantly in the opportunities created by these strategic choices in the energy transition, the financing of medium-sized companies, cybersecurity, defense, the financing of strategic infrastructure such as data centers, regenerative agriculture, or real estates. Number 4, the European Central Bank is firmly engaged in a cycle of interest rates cuts, which admittedly is probably coming to an end, but marks the institution's willingness to support a fiscal stimulus in the area. Number 5, valuation of European assets are lower than US valuations in both the listed and the enlisted world. Number 6, European companies operate with lower debts than in the US. So for the first time since the end of the Second World War, European thus combines 4 elements that create economic value: a fiscal stimulus policy, an accommodative monetary policy, an attractive valuations, and leverage in companies lower than the one US companies operate with. In this context, we maintain the strong conviction that has led us for several years to focus on investments in building resilience and sovereignty in Europe, whether in private equity, private debt, listed equities and corporate bonds, or real assets. We remain convinced that investing in Europe selectively and while respecting local roots to support the massive needs for investment spending, the revival of industrial policies and the development of European champions in their resilience building will be a considerable vector for creating financial and extra-financial value in the coming decades. But does building resilience create economic value in Europe? Well, obviously, building resilience has a cost. Cost of insurance, climate risk insurance, cyber and insurance of the risk related to the activities of the company, but also higher cost of capital and financing. The uncertainty generated by deglobalization and higher interest rates are forcing companies to operate with higher capital buffers to absorb shocks, but also the cost of capex. Building resilience requires considerable capital expenditure. These capex have a significant cost. Reshoring implies higher wage costs for Western companies. Cost of operating with larger inventories is also a problem. Building resilience involves building up stocks for companies, but also for governments. The debate on strategic reserves is resurfacing for all the major economic areas. Defense-related costs also. Germany becomes the 4th largest military budget after the United States, China, and Russia. It therefore seems obvious that a less optimized and less efficient world implies lower growth. The big question then remains, can this generation of resilience create significant value? We think so for several reasons. Investing in the solution providers of this resilience, companies that benefit from strong demand from economic players to equip and protect themselves, will generate strong growth in a world of low growth. Leaders in the energy transition solutions, cybersecurity, and defense-related industries are already benefiting from significant growth trajectories. In defense, the move toward collaborative warfare, i.e. small, inexpensive objects like drones, for example, connected to each other to inflict larger damage on large, expensive objects like planes and ships, requires massive investments in artificial intelligence, space, quantum computing, and cybersecurity. The resilience will also be built through consolidation and concentration. The creation of European champions will generate economic value. We see the financing of this consolidation through private debt as a significant investment opportunity in Europe. Investment in strategic infrastructure, notably financed by the German plan, will create competitiveness shock. We believe that the financing of data centers represents an excellent opportunity in this area. The transition to a war economy will lead to the conversion of businesses. The war economy does not only mean rearmament, but essentially consists of keeping control of one's productive tool in order to be more resilient. It also consists of good management of independencies, the conversion of industrial production tools like factories, the repositioning of infrastructure like satellites or power plants, or even the change of use in buildings will create economic value. For example, we see in value-added real estate an opportunity in Europe. The logic of sovereignty should create positive feedback loops for European companies. For example, to date, Europe buys only 18% of its military equipment from Europe, indicating a strong preference for key US military programs such as the F-35. The countries of the European Union recognize that this share will have to be gradually increased to reach 30 to 40% in the coming years. Even if it is synonymous with low growth and less optimization, the creation of resilience can generate a lot of economic value for the investor, provided that the investor remains disciplined in the valuations of the asset acquired, in the structure and the cost of capital allowing these acquisitions, and provided that there is a strong local anchor for the origination and execution of investments. As a conclusion, we are convinced that dispersion will create massive investment opportunities for asset managers that are disciplined by DNA, i.e. enjoying strong alignment of interest, but also with a strong local footprint. Thank you very much.